Mike, we know that state and local taxes have always been so important in the staffing industry with workers working everywhere, crossing tax jurisdictional borders. But it's become particularly more prevalent in the COVID world. You want to tell us what you're seeing out there in staffing?
Yeah, BJ, over the past couple of years, we've been seeing an increase in activity with clients crossing state lines, but with COVID and the work at home workforce has definitely opened our clients' eyes to the importance of SALT, basically state and local tax compliance. So we're seeing more of our clients who have customers in one state, but they have their workforce completing that work in another state, which is creating potential nexus, which is the connection between a compliance and filing in a state. So our firm has a team dedicated just for state and local tax because every state is different. Our number one rule, BJ, with our staffing clients is be proactive. Let us know in advance what state you are potentially operating in. Where's your workforce located? Where's your customer located? Is your workforce entering into another state? Does that potentially create a reporting compliance issue? And most of it is just compliance. It's just reporting. We have a real world case where in Texas, a staffing firm had a Texas internal employee working out of Texas. And 3 years later, Texas has been looking for a business tax return, assessing hundreds of thousands of dollars of potential penalties. So it's important to understand where the work is being performed and where your customers are located.
Right. And, it's a key just for income taxes, payroll taxes, state registrations. It's so important. If you're in staffing, in all likelihood, you've got someone crossing a border somewhere working. The other thing that keeps changing, both before and during the COVID environment, is states changing allocation of and rules governing where revenues are to be sourced for income tax purposes. It used to be that if you had a perm placement in Montana and headquarters was in California, California would be the site of most of the work that was performed in placing the candidate, and the revenue would be sourced to California. Now, however, states are moving away from what's called a cost of performance allocation methodology to a market-based methodology, which says that maybe in the case that I just outlined, the revenue and the filing requirements may end up in Montana. So this is a Byzantine area that you really need to stay on top of. There's actually some great planning tactics that can be taken to minimize those cross-border tax compliance and planning issues.
And I'll just add one more thing, BJ. There are several states that have local reporting requirements. Ohio is a great example where there are localities that are requiring business tax returns. So it's important to understand in whatever jurisdiction you're operating in that you are in full compliance with state and local tax laws.
Pennsylvania too, sales taxes in several states as well. So you need to monitor all of these things and be proactive about your planning.